A small town in northern Norway lost everything in 2007. Narvik, 18,000 people. Fishing boats in the fjord, schools, a hospital, a pension fund worth billions. But here is what makes Narvik strange. Narvik never made a single loan to anyone in America. And yet Narvik lost everything to American mortgages. Nobody in Narvik had heard the word subprime. They fished. They sent their kids to school. They paid into the pension fund every month. Most of them had never even been to America. But across the ocean, 8,000 kilometers away, a couple in Florida signed a mortgage they could never afford. A broker took the loan to a bank. The bank bundled it with thousands of others, mortgages stacked like cards in a deck. A rating agency stamped the deck safe. A salesman carried it across the ocean, and he sold it to Narvik. But by the time it reached Narvik, no one could trace where it began. It looked like a quiet, boring bond, reliable, government-rated. Then the Florida couple stopped paying. The bond cracked. Then the deck cracked. Then the pension fund vanished. A town in the Arctic Circle had lost its future to a couple it had never met. Think about it like this. Behind every step of that journey, a machine had quietly turned bad bets into safe-looking assets and routed them into pension funds in Holland, sovereign wealth in the Gulf, and small towns in Scandinavia. The machine has a name. Most people outside finance never learned it, but everyone alive has felt it work. Why did trillions of dollars decide to bet on American houses? It started with a single decision in a single room. After the dot-com bubble burst in 2001, the Federal Reserve cut interest rates from 6.5% down to 1%, the lowest in 50 years. That sounds technical, but here is what makes it strange. A pension fund holding billions of dollars cannot survive on 1% a year. Neither can a sovereign wealth fund. Neither can an insurance company. Neither can a small Norwegian town saving for its hospital. They all need something better. So begins the hunt for yield. Picture a vast, hungry herd of money roaming the planet. Trillions of dollars looking for somewhere safe and somewhere paying. Government bonds were paying nothing. Stocks had only just stopped falling. Everyone with savings was asking the same anxious question. Where do we put it? Then the American mortgage market raised its hand. American house prices had not fallen on average since the Great Depression. Mortgages paid more than government bonds. Mortgages looked almost as safe as government bonds. The herd noticed. The herd moved. $5 trillion rolled toward the United States housing market. The money came from pension funds in Holland, sovereign wealth funds in the Gulf, quiet little banks in Scandinavia. None of it was actually about houses. It was about hunger. In 1980, getting a mortgage in America was a slow, awkward conversation. You sat across from a bank manager who knew your job, your neighborhood, your parents. He lent you money he expected to get back. If you stopped paying, it was his problem. So he was careful. But by 2005, that conversation was gone. The man writing your mortgage in 2005 did not work for the bank. He did not lend the money. He did not keep the loan. He was paid a commission the second you signed. After that, the mortgage was someone else's problem. The man writing your mortgage was called a broker. Picture this: a waiter who is paid for every plate he serves. He never has to taste the food. He never has to clear the table. He is fired only if the kitchen runs out of plates. The faster he serves, the more he earns. Quality is not in the equation. The result was an explosion of loans that should never have existed. Mortgages with no income check. Mortgages with no down payment. Mortgages whose monthly cost would double after 2 years, given to people who could not even afford the first version. In the industry, they had a name for these: ninja loans. No income, no job, no assets. 40 million subprime mortgages were written between 2003 and 2007. 40 million. Nobody was checking. Nobody had a reason to. A single mortgage on its own is not a thing Wall Street can sell. It is too small, too specific, too tied to one nervous family in one specific town. But thousands of mortgages, glued together, become something else entirely. They become a bond. Here is how the trick works. A bank buys 10,000 mortgages from brokers across the country. It pours all the monthly payments into one big pool. Then it sells slices of that pool to investors as a single financial product. The product is called a mortgage-backed security. The slice you buy pays you a share of every mortgage payment in the pool. It is like blending 10,000 bottles of wine of unknown quality and selling glasses from the mix. Any single bad bottle disappears into the blend. The drinkers are happy, the blender is rich, nobody is checking the bottles. Then someone had a clever idea. Take the leftover, riskier slices of many different pools, pour them into a new pool, sell slices of that. This was called a CDO, a collateralized debt obligation. Then they did it again with the leftovers and called it a CDO squared. By 2007, Wall Street was selling bonds built out of the worst mortgages in American history. The original families had been forgotten. The bonds had names and numbers and credit ratings. They no longer looked like loans, they looked like math. By now, the bonds at the top of the stack were so abstract that no human being could really understand what they contained. A pension fund manager in Holland could not read 1,000 mortgage files. She needed someone else to tell her the bond was safe. That someone was called a credit rating agency. There are three big ones: Moody's, Standard & Poor's, Fitch. Their job, in theory, is to be the referees of the bond market. They examine a bond and give it a letter grade. AAA means almost zero risk of loss. Pension funds are legally required to buy AAA. The mortgage bonds came back from the agencies stamped AAA. Even the CDOs, even the CDO squareds. Bonds built out of the worst loans ever written in American history were officially as safe as the United States government. But here is how the rating agencies actually worked. Imagine a school where the students grade their own tests, where the school pays the grader, pays more if the grade is high, pays nothing if the grade is low, and quietly fires the grader and hires a different one if the first grader is too strict. That was the rating agency business model. The banks paid the agencies graded the bank's homework. If an agency was tough, the banks took their business elsewhere. AAA was not a verdict, it was a product the banks were buying. At this point in the story, a sensible person might ask a sensible question. What if the bonds go wrong anyway? The banks had an answer ready. The bonds were insured. A company in Midtown Manhattan called AIG had quietly become the world's largest seller of mortgage bond insurance. The product was called a credit default swap. A bank buys the swap. If the bond defaults, AIG pays the loss. For a small fee, the risk vanishes. By 2008, AIG had sold credit default swaps on more than $400 billion of mortgage bonds. But here is what makes that strange. Insurance at this scale requires reserves. A real insurer holds money against the day claims arrive. AIG held almost none. It had been treating credit default swaps as a free fee, and the money flowed straight into bonuses. Picture a man at the edge of a cliff selling parachutes for $10 apiece. He has no parachutes, only the $10. While no one jumps, he is the most profitable parachute salesman in the world. Banks now believed their bonds were safe, AAA and insured. Believing this, they borrowed against the bonds at 30-1. For every dollar of their own money, they held $30 of mortgage exposure. A small drop in the bonds would wipe them out completely, but the bonds were safe. By the spring of 2007, something quiet and terrible was happening in suburbs across the United States. The teaser rates on millions of subprime mortgages were ending. Monthly payments doubled. People who could not afford the first version had no chance with the second. Remember the couple in Florida? The one who signed a mortgage they could never afford. They stopped paying, and so did a few thousand others, and a few 100,000, and then a few million. House prices, which had only ever climbed, began to drift sideways, then down, then faster. The pools at the bottom of the machine started to leak. The mortgage-backed securities priced off them lost value. The CDOs built from the worst slices lost more. The CDO squareds were essentially worthless. AAA bonds were trading at 30 cents on the dollar. Picture a great steel skyscraper. Every floor welded to the floor above. Every floor built on the assumption that the floor below cannot move. Then the ground floor moves. The whole building does not crack slowly. It buckles all at once. And the bank holding $30 of mortgage exposure for every dollar of its own money, that bank no longer existed in any meaningful sense. It had simply not realized it yet. On the inside, it still felt rich. On the outside, the ground was already gone. In September of 2008, Lehman Brothers ran out of room to pretend. It was the fourth largest investment bank in the United States. It held more than $600 billion of assets, most of them tied to mortgages. On a Sunday night in New York, it filed for bankruptcy. The next morning, the world stopped working. Money market funds broke, short-term lending between banks froze. Companies far from mortgages, airlines, factories, hospitals, could not borrow the cash they needed to pay staff on Friday. The plumbing of the global economy ceased, and AIG, the parachute salesman, was suddenly being asked for parachutes. Hundreds of billions of dollars in claims arrived in a single week. The company had nothing close to that. Without a rescue, every bank holding an AIG-insured bond would discover at the same moment that its insurance was imaginary. And here is where the twist arrives. Quietly, in the middle of the panic, the crisis was not caused by bad people making bad decisions in a moment of weakness. It was like discovering, after the building has fallen, that the architect was paid by the cement company to certify that the cement was strong. The machine was designed this way. The ratings were bought. The insurance was fake. The leverage was a choice. The loans were a product. Each link looked sensible. Each needed the next to lie. Governments responded the only way they could, with money, in quantities the public had never imagined. The United States Treasury committed $700 billion to buying up bad assets. The Federal Reserve quietly extended $4 trillion more in emergency loans. Britain nationalized banks that had been household names a month earlier. The bleeding stopped. Then came the question of what to fix. In 2010, America passed the Dodd-Frank Act, the largest financial reform since the Great Depression. Banks had to hold more capital. Risky trading was restricted. New agencies were created to watch the watchers. On paper, the machine was disarmed. But here is how that looks if you read the small print. The credit rating agencies are still paid by the people whose bonds they rate. The same conflict of interest that produced AAA subprime is sitting in the same chairs, drawing the same fees. Almost nobody went to prison. One banker, out of millions. The securitization machine never went away. It just learned new things to package. Today, the same logic is applied to car loans, to student debt, to corporate loans bundled into something called a CLO, which is structurally identical to a CDO and is often rated by the same agencies that rated the original mortgages. In 2023, a Californian bank called Silicon Valley Bank failed in 2 days. The mechanism was different. The root cause was the same. Leverage against assets nobody had repriced in time. The piggy bank in Narvik filled up again. So did pension funds from Holland to the Gulf. And the machine that emptied them in 2008 did not get fixed. It got rerouted. The story we tell about 2008 is usually a story about bad people, greedy bankers, reckless borrowers, asleep regulators. Those people existed, but the story misses the machine they were standing inside. The machine was not designed by anyone in particular. It assembled itself, link by link, over 20 years, out of small decisions that each made sense at the time. Cheap money looked for yield. Brokers chased commissions. Banks chased volume. Agencies chased fees. Insurers chased premiums. Pension funds chased safety. Every actor was rational. Every actor was rewarded for the next link being a lie. Nobody had to be evil. The system did the evil for them and paid them a bonus for helping. Think about it like this. If you build a machine where every honest person loses to every dishonest person, The dishonest people will not necessarily win. The honest people will simply leave. Then the machine will run on whoever stayed. And the machine will keep running, because the machine does not care who is operating it. The crisis ended in 2009. The machine that caused it did not. Every few years you will hear a small tremor, a bank, a fund, a small town in Norway, and you will wonder if this is the start of something. Sometimes it will be. The machine is still running, and you are standing inside it.